Welcome back to another Lumi Investment Corner. With us once again, Michael Zaremski, Head of U.S. Private Banking, Bank Lumi USA, member of the Investment Committee for Lumi Investment Services. Good to have you back again, Michael.
Great to be back, Zev. Hope everything's going well with you, and thanks for having me.
Thank you. We're past the election. We're back to normal. Since we spoke last time, the Feds had convened, so I was curious to get your reaction to what the Feds are doing and what the market reaction is.
Yeah, terrific, Zev. I think it's a great question. And when we spoke last time, the Fed was about to convene and provide us with their all-knowing knowledge of the marketplace and what they were going to be doing going forward. And as usual, everybody waits for the Fed's announcement with such bated breath. And when the announcement comes, everybody is trying to discern all the nuances of what they actually said and what that means and how we go forward from there. So just to give you a couple of quick thoughts from my perspective, and again, these are my views, not necessarily those of the bank or the broker-dealer. But again, with all the anticipation of the Fed announcements, what we really did see was a tremendous amount of volatility over the last couple of weeks. Folks were trying to figure out what the nuances were, what the words meant, what the dot plots meant, et cetera, et cetera. And ultimately, I think there was just a whole lot of smoke, a whole lot of noise over a whole lot of nothing. Ultimately, markets have kind of settled back in. People kind of forget last week was triple witching for options. So there was a lot of options expirations that happened last week that typically coincides with some market volatility. So that plus the Fed just really created a lot of noise in the market. Prior to the Fed meeting, rates were kind of hovering in a range between right around 150-ish, maybe a touch higher. Post the Fed meeting, they jumped up sharply because people had one particular view of kind of a more aggressive Fed stance. Then people changed their minds a little bit, and we saw the 10-year rates drop back down to about 135 at its low. And lo and behold, 2 weeks later, they're sitting right back at the starting point of about 150. So a whole lot of nothing happened except for some volatility. And that's pretty much the theme of what we see across most of the markets that are most sensitive to the Fed. The one area that I did think was a little bit interesting is we've seen the 2-year part of the market, which is a little bit more sensitive to rising interest rates, start to creep up a little bit. But the magnitude of these moves is, 10 basis points. So again, 10 basis points is a lot on a very low base, but it's just not a whole lot of movement. What I'd like to point out to the listeners here is, in basically a stroke of the pen back at the beginning of the pandemic, the Fed cut the overnight lending rate by 150 basis points. The typical expectation for the Fed is that they will, at some point when they do start to increase rates, it'll be about 25 basis points per meeting. That's kind of what the standard pathway has been, unless they are, going to have to move more aggressively. That basically means about 6 meetings. If they meet every 6 weeks, that's about 36 weeks if they do everything kind of in lockstep in that manner. And they're not talking about raising rates anytime soon. So a lot of focus on far out movements of what might happen in 2024. Will things get pulled up a little bit in 2023? And ultimately, I think there's a whole lot of noise about nothing. And the only other things that we've really seen is equity markets continue to rise. And we've also seen some stability within the commodities markets. The Fed has talked about transitory inflation, and Zev, we've spent a lot of time talking about transitory inflation. And I think what's been interesting, and we've highlighted this over the last couple of calls that we've had, it's interesting to see elements like lumber, which about a month ago were trading, they traded up as high as about 1,700 from kind of a typical base of about 300 or 400. They're now back down to about 900. So again, in the Fed's world, the goal was to get some inflation, so we're now meaningfully higher than we were, let's say, 2 years ago. But we're significantly down off what the peak was, which kind of, again, is definitionally transitory inflation. You've seen similar movements starting to happen in copper. Copper is another element of the housing market. Timber and lumber are very much associated with the housing market and new construction. As prices for these commodities rise, typically people start to slow down on consuming them and prices start to drop. So there's no real scarcity of materials. It's just a question of pricing. And at some price point, the market self-corrects and people kind of shift over into other areas of consumption. that's kind of a couple of quick thoughts, but happy to entertain any further questions.
I was thinking about you, Michael, when I read the Wall Street Journal about the lumber, or was it the New York Times, how it really prices went so down. So what you were talking about, transitory inflation, where the prices went up to a large amount and now getting back to normal because it's supply and demand. And the more they're able to increase production, the more the prices go down because there's more product on the market, which is what you've been saying all along.
Absolutely. So, Zev, maybe the Wall Street Journal is listening to your radio shows here.
I'm listening to you because I thought of it when I read the article. I said, this is what Michael's been talking about. So it definitely that came to mind. In fact, had you not raised the lumber issue, I would have raised it because that was my thought when I saw the piece in the paper.
Yeah. The other comment that I would make also is, a lot of times we start to read the headlines and we start to see what's in the news. And again, we've talked about this quite a bit in the past. Everyone continues to look for black swan events, and the black swan events are those unpredictable events that will come in and impact the market pretty significantly. And as I like to remind clients all the time, if you and I can speak about and talk about the black swan event, chances are it's not the black swan event. And I think that we should continue to expect things that may be somewhat unexpected. And there's no way to really plan for that other than what I would tell people is just think about the big picture. Continue to focus on the bigger long-term macro events. And when we look at the U.S. economy, when we look at the U.S. markets, you continue to see, robust recovery. I couldn't help but notice over the weekend all the plane traffic coming over Long Island, and plane traffic over Long Island from the east means planes from Europe or planes from other parts of the world. It's something that, again, you're seeing happen on a more regular basis. You're seeing airport traffic pick up. You've recently seen the amount of people moving through TSA getting up to and approaching 2 million people per day, which goes back very close towards pre-pandemic levels. And regardless of any of the short-term stories and any of the short-term fears, I think the number one biggest theme that we continue to see is reopening and recovery and movement back towards normal. We see it in the city by people going back to the office on a more regular basis. The trains are getting more crowded. Traffic is picking up, and you're continuing to see more and more activity. And ultimately, this activity is going to translate into continued pickup in GDP. And I think we talked about this last time. GDP levels are at all-time highs in absolute numbers. We've eclipsed the GDP that we saw prior to the pandemic, and we've done so with less people employed. So again, huge productivity gains and an economy that, in my opinion, is going to continue to grind higher. And with that, you're going to continue to see stocks basically continue to grind higher. And, as I said, with all the negative news stories and all the turbulence, NASDAQ hit a new all-time high this week. S&P 500 is sitting right under the all-time highs that it hit last week. And again, it's a market that just continues to want to go up because it's supported by very strong underlying fundamentals of reopening and recovery.
Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Thank you for your insights again this week.
Thank you very much, Zev, and great speaking with you, and have a good day.
And we're going to be right back. Don't go away. Stay